Joe Curtis, welcome to Questioning the Manager. Now, it seems UK equity income investors are shifting a little bit more capital overseas as yield seems to become hard to find in the UK. Are you finding this? And if so, where are you buying overseas?
I'm not really finding that, to be honest. I think that there's plenty of opportunities in the UK. Obviously, the general election result has obviously given some clarity going forward in the sense that people are expecting a coalition government, quite a messy coalition potentially, and we've got a majority government, which should be helpful. So at the moment, there are certainly opportunities overseas, but I don't see any fewer opportunities in the UK than there have been.
Okay, now the Bank of England is talking about rate rises potentially this year. Do you think this is going to have much of an impact on your portfolio and the way you invest?
Well, the Bank of England have been sort of notifying people or marking people's card that interest rates could start to go up. I mean, inflation at the moment is, of course, very low and at zero. And the Bank of England is also saying that any interest rate increase will be really quite gradual and measured and small. So I think the most we'll see is a quarter-point interest rate increase later on in the year. I mean, obviously it is a turning point, but it's sort of beginning of a normalisation of financial conditions, and it's a reflection of the growth of the economy. So I think the new norm ultimately will be more like 2 to 2.5% interest rates, which is way lower than they were if you go back. So I'm not too concerned about it at the moment.
Now, investment trusts have the ability to gear, that is, borrow extra money to make extra investments. Citi gears. Is it wise, with long-term rates so low, that maybe Citi would think about putting more longer-term gearing in place?
Yes, we did do a private placement worth about £35 million in January of 2014, which was at an interest rate of 4.55%. So we have been taking that for 15 years, but we believe in a combination of secure long-term borrowings such as that, and also using short-term borrowings more opportunistically. And we have a large bank facility which is worth about £80 million, which we can use. At the moment it's not drawn down, but we can use it tactically in markets.
Okay, finally, Joe, now there are relatively frequent macro events that go on in the economies. For example, the elections that you mentioned, the Greek crisis. Does this affect the way that you invest, and does it cause you to change the way in which the direction of your investments, basically?
Well, I think I can't sit in an ivory tower. You obviously have to know what's going on in the outside world. But for me, that's the sort of share price valuation that's the key determinant of future return. And I particularly look at dividend yields and the growth of dividends and our sustainability. And so to the extent that kind of macro events affect that, then obviously it does matter. But often, the short-term panics can lead to sort of good buying opportunities. I'm not driven by the macro, but it's not as if I totally ignore it.
Joe Curtis, thank you.